Welcome to the Investing Markets and Money podcast, our regular podcast about what's going on around the world in global financial markets. And on the podcast today, we'll be talking about commodities, very important topic for a lot of investors. And joining us is Nitesh Shah, who's head of commodities at fund manager WisdomTree. And we're going to be taking a look at some of the bigger markets and how they've been performing recently. So listen in and find out a little bit more about what's happening. Welcome back to the Armchair Trader Investing Markets and Money podcast. And this week we're talking about the commodities markets again. And one of our regular commodities commentators, Nitesh Shah, who's head of commodities and macroeconomic research at WisdomTree, is joining us. Welcome to the show, Nitesh.
Thank you. Thank you for having me back on your show.
It's very good to have you back. And I want to talk about some of the key commodity markets today. I mean, there are some that are very much in the news right now. Obviously, gold is a big subject. It's been having a really good run. We've always been quite bullish about it, partly because, well, originally we were bullish about it because of its anti-inflation characteristics. But more recently, as geopolitical risk has been ratcheting up, we've seen the gold price continue to go up. We were starting to call it at 1,800, and now it's at touching the $3,500 level. What's your view on gold? What's happening with that at the moment? I mean, there's obviously a lot going on in the political arena, but do you think that's a sustainable price, or is it going to drop if things suddenly go quiet again?
Yeah, so I think you touched on a number of things that are supportive for gold prices and highlight why gold is such a unique asset class. It is a brilliant hedge for geopolitical risks, for economic uncertainty, and financial market uncertainty. It is that one of the best inflation hedges out there. And what we've got going on in the background is likely to push several of those buttons. The trade war, which was driven by the Liberation Day increase in tariffs from the US, have really increased the risk of higher inflation just through the mechanical force of more tariffs mean the end prices of goods and services, at least in the US, and those countries that are doing retaliatory tariffs, they will likely increase. But also they have an impact of potentially dampening economic demand. So there is that kind of recession risk. So, and financial markets have been uncertain how to interpret all these events because things are changing so rapidly every day. So gold has been, the antithesis to all of those things and has accelerated. That's why we saw gold get to 3,500 intraday in April. And since then, we've seen geopolitical risks add to gold support. So where we may have seen some of the worst case scenarios around tariffs ease off a little bit, that's been substituted with geopolitical risks. And obviously chief risk at the moment is what's going on in the Middle East. The airstrikes from Israel to Iran and the strikes back again. The trading of missiles between the two countries has obviously escalated the situation. So all these risks are unnerving investors and adding support to gold prices. We've seen a tiny bit of easing on prices in recent days, partly because the Fed held off from making any statements about near-term rate cuts, and in fact just gave the impression that they're in a hurry. Moreover, the Fed's dot plots seem to indicate that the rate cuts that they were planning for 2026, some of them were off the table. The hopes for a lower interest rate environment have been diminished and therefore taken a little bit of the edge off gold prices. But we believe there's so many risks out there that gold prices are around the corner from surging to a brand new high.
Right. And do you lend any credence to this theory about de-dollarisation and that the world is looking for another reserve currency? I was at a hedge fund conference last week, and one of the guys on the stage said we're gonna be in a situation soon where we have two reserve currencies, the US dollar and gold. I mean, in that situation, I mean, the sky's the limit for gold.
I think we're already there in some ways. If you a few weeks ago, the European Central Bank put out a paper on the euro as a reserve currency, and a key chart within that showed all the reserve currencies in the world, including gold as that pseudo reserve currency, and you could see that gold was already in second place. It was dollar, then gold, then euro, and then everything else. And the everything else bucket was smaller than gold. So, and euro was also smaller than gold. So, you can see that, gold has already become the second reserve currency in the world. And it's only increasing in prominence. Central banks are just clamoring to get hold of gold. Every year since 2022, central banks have been buying about 1,000 tons of gold, or over 1,000 tons of gold, and that's more than double of the levels that we saw on average in the decade prior to 2022. Now, central banks surveyed by the World Gold Council, they just put out their survey a few days ago. It's an annual survey, and when central banks were asked, do they think there's a group will be increasing their gold holdings, 95% of the central banks said that they agree that they'll be buying more. That's the highest number on that survey question since the survey had begun. So it is clear the direction is that central banks will be accumulating more gold. I think the events of 2022, when the Russia-Ukraine war started and G7 countries sanctioned the Russian central bank and froze the central bank's assets in their currencies, has spooked central banks almost on a permanent basis, and that there are a large number of central banks out there that don't have anywhere near as much gold as I'd like to have. So I could see this level of buying for decades.
That's amazing. I mean, if you think about it, central banks prioritizing gold over the euro, I mean, that's just incredible, isn't it? I mean, I guess that's partly because you can't print gold like you can a currency, and also it's very apolitical at the end of the day. No one's controlling its supply, basically.
Absolutely. Gold, unlike fiat currencies, can't be printed at will. They can't be debased. So central banks have a lot of comfort with it. They don't think that they'll get any currency depreciation with gold. And when surveyed, these central banks, they don't really admit to the fact that they're de-dollarizing or reducing their exposure to other reserve currencies. They tend to rank that as one of their lowest reasons. They're not necessarily being the most truthful, I would say, but they do tout gold's other traits like inflation protecting capabilities and everything we talked about, right? Hedge against market instability and economic instability. So and its chief role in geopolitical risks. So central banks, when asked why they hold gold, is pretty much for the same reasons everyone else should be holding gold. It should be a key part of a strategic allocation to a portfolio.
And do you think it's true that the central banks buy gold through intermediaries as well? So you get your official buying of gold that everybody watches, but some gold traders say to me that central banks also acquire gold through, I mean, not necessarily something like the Bank of England, but some other central banks, I'm not going to mention any names, use other state-owned entities to quietly also buy gold, so it's not signaling that they're buying as much as they really are.
Yeah, I have to say, central banks are pretty much awful at reporting their data on gold buying. The numbers that they submit to the International Monetary Fund in their International Financial Statistics, IFS statistics, are probably about a quarter of the actual volume that they're actually buying.
Really? Wow.
And if you look at the quarterly data that's published by others like Gold Council and Metal Focus, you can see that that's probably a little bit better in terms of estimating. But once again, it's an estimate, and it's clear that central banks have many channels to get hold of gold. Some countries have gold mines and in their countries and have direct buying programs with them. I certainly think that Russia, after its gold has been taken out the good delivery system, so it can't. Russian refineries can't deliver their gold into the London or Zurich markets, for example. It's got a captive buyer of the government, right? The government can just buy directly from the mines and refiners. But other countries, China has been reporting gold purchases every month since November, but their volumes look quite small relative to the volumes of gold going into China. So there is probably some discrepancy there to be noted, and certainly we do think that the PBOC, this China Central Bank, is probably acquiring more gold than that. So and the official, if you just look at official figures. China's gold to other FX ratio or as a percent is only under 7%, which is tiny compared to the big central banks of the world, like or the monetary systems in other parts of the world, like say, the US, Germany, Italy, France. They have like 70% on that ratio. But even countries like India have 10%, Russia close to 30%. So China's numbers do look small when taken at face value, but I do think that it's building up a larger position, but not necessarily that the data is easy to obtain.
No, understood. And I want to talk about silver as well. Silver has been a little bit of the sort of ugly sister to gold recently. Silver had a really good run after the big financial crisis in 2009, 2010. But it trailed gold. The gold took off first, and then silver took off a bit later on. But I was also on a silver panel at a conference, the Resourcing Tomorrow conference in December last year, and everyone on that panel was massively bullish. And the thing they said that had changed about silver was that they anticipated that the industrial consumption of silver was going to be different now, and that's a new dynamic in this market. Recently, we've seen the silver price start to take off. There's a lot of silver bulls out there in the market, and every time it does it, I get sent loads of research by them, and then it always comes off again, and they all go quiet, and then it all starts all over again. And it's been happening over the last couple of weeks again. So, what's your take on the silver market?
Yeah, I think you rightfully note the correlation between gold and silver. They tend to move in the same direction. There's roughly an 80% correlation between the two if you look at long-term historical averages. But silver tends to have a kind of higher beta to gold. So, my model indicates that for every percent increase you get in gold prices, silver has tended to increase by 1.4% before factoring other things in, because there are other things that drive silver in addition just to its relationship with gold. And I think it's important to probably think of those other things. So the other things that influence gold are things like industrial demand, supply of the metal. And I guess in the backdrop of a trade war, people are worried about industrial demand in general. And gold possibly has more support from being that true geopolitical hedge. Silver is a secondary hedge. It's just a hedge by correlation. I think gold has had that slightly upper hand in this in the year so far, but it's not to discount silver's strong fundamentals. Silver, its own industrial uses are actually bucking the trend, right? While we've been living in we could almost call it an industrial recession in Europe and other parts of the world for the best part of 3 years. The industrial demand for silver has gone through the roof. It has been increasing every year, and a large part of that is due to its role in photovoltaics, solar panels, and electrification more generally. Between 2021 and 2025, silver demand in photovoltaics has doubled. That's a pretty substantial role, and about 50% of all silver use is goes into industrial applications, and about 30% of that industrial demand, 30% of the 50% is in photovoltaics. So that is quite substantial as a source of demand, and we think that solar, now that it's become extremely cost effective, will continue to grow. And it's been growing at a strong pace in recent years. The more newer and more efficient solar panels tend to use more silver loadings in each panel as well. So that is actually helping to support silver. Now, the gold to silver ratio, an indication of the relative pricing between the two, had shot up to over 100, which is about close to 2 standard deviations, or just above 2 standard deviations above historical average, earlier this month. But now that is corrected with that rally that you mentioned with silver. So, the ratio is closer to 90. It's still about standard deviation above average, but I think that's probably a sustainable level because gold should have that little bit of upper hand, but not too much. Now, I believe from here on now, as till for the forecast for the coming year, for every increase you get in gold prices, you should get an increase in silver prices. So silver prices are likely to continue to rise, and our Q1 2026 forecasts for gold are 3,750 and dollars per ounce, and $40 per ounce for silver, and silver prices are just over $35 an ounce today.
Understood. And the gold silver ratio that you mentioned, that's a calculation that people use to try and work out whether silver is underpriced or overpriced. And,
Yeah.
Do you think that's a valid measure? And I know a lot of precious metals traders use it, but is it something that's a good indicator?
Well, it's one information point, right? It's using that in isolation and not looking at any of the fundamentals could lead to a misleading picture. But it does give, when it does become stretched, it does give warning signals. And the last time before this current episode, we saw that ratio getting stretched was around 2020. And well, at that point, we saw it become really stretched. It was about sort of 4 standard deviations above average at that point. But once the correction started, when silver started to rally, we saw a 95% rally in silver prices.
Crumbs.
So obviously that was
the pandemic as well.
That was a pandemic, yeah. So obviously things were a little bit more stretched in that time period. So I'm not saying that we'll get that kind of rally this time round, but it does give a good information point. There has to be reasons for why one metal should be trading way above another. And we can account for part of it this time because there is geopolitical risks that are driving gold prices, but there's something more to it, and we believe that silver has had a little bit of a catch-up, and maybe could do with a little bit more catch-up from now on, but we really think that the ratios will probably remain in that 90s region, but taking both metal prices higher.
And is it true that the silver market itself is just slightly less liquid than the gold market, and that it's heavy buying or heavy consumption can actually have much more of an impact on the silver price than the gold price?
Yeah, it's a significantly smaller market, and it's I guess there's less institutional investment in silver compared to gold.
Yeah.
So when you do get institutional interest, it can make the market a little bit more skewed than it has been previously. We also sometimes periodically see strong retail demand for silver investments as well, and that can have a bit of an influence on price. It tends to be quite temporary, but it does happen. But the one key thing I would probably note with silver is that most of silver supply is a byproduct of mining for other metals. So 75% of silver comes as byproduct from mining for other metals. So despite the fact that prices have rallied, it doesn't mean that miners are going to think, "Oh, great, we can lock into this opportunity and start mining more," because most of the miners that are producing silver are mining primarily for other metals like zinc, copper, tin, for example, and they're looking for price signals there before they increase supply. So supply conditions can remain tight in silver markets for some time, and we have been in a supply deficit for silver for the last 4 years, and we're likely to be in the 5th year this year.
And just quickly, I wanted to ask about platinum, because platinum is the other precious metal, doesn't get mentioned as much. How's that doing, and is that something worth looking at if you're, some people be long gold or long silver as well right now, but is it even worth having a platinum position, or is it just too niche?
Well, funnily enough, platinum has outperformed both gold and silver this year. So if you're looking for price performance, clearly it's done something fantastic. And, it moved later than gold. Once again, there's almost a rank ordering of correlations in the precious metal market. So silver is more closely correlated to gold. Then you got platinum, and then least of all is palladium, and then obviously you got the minor other metals which don't really have much of a correlation. And so platinum is a bit more of an industrial metal, even more industrial than silver, and its main application is in auto catalysts in cars. So it's the thing that turns all the nasty gases into safer gases in an internal combustion engine car. Now, platinum has been a bit of a dog for several years because of projections for internal combustion engine vehicles declining in favor of electric vehicles, and that's hurt both platinum and palladium. But it has had a bit of a recovery relative to palladium, for example, because the demand for platinum has been increasing within the auto industry, switching from palladium to platinum. So it's had a bit of a relative improvement in performance over the last few years, but it has been actually in a supply deficit. It's the amount of palladium used in applications has been a lot less than the mine supply, and part of that is due to mine concentration. About 70 to 80% of mine supply of platinum comes from South Africa, which has had periodic problems with energy. It's had periodic problems with labor markets, and also operational problems at some of the miners in recent years. So we believe that not a lot that's going to change. We do think that there's going to be a lot of difficulty in getting more platinum out of the ground. So we're probably likely to go to another year of a supply deficit, even if demand in the auto industry is cooling off. But we knew this in January and February and March, right? The prices rallied pretty hard in the month of May. Coincidentally, during London Platinum Week, so I think the market got a lot more attention during that week.
Right.
Various forecasters were publishing their forecasts during that week, allowing more attention to these deficits and supply concerns, and that's really when prices took off. But I do think these fundamentals will remain quite firm for the remainder of the year, and platinum will be playing as a good correlation play to the rest of the precious group. And one last thing is that with gold so expensive today, jewelers are likely to be switching over to platinum. So consumers are likely to move to a slightly cheaper, more affordable metal. And previously, in decades past, platinum was seen as a premium metal to gold, right? And that still stays in the psyche of various consumers.
Yes, my wife used to be a metals journalist, and she always prefers platinum jewelry to gold because she understands the intrinsic value. But interesting what you said about London Platinum Week as well, because there you have all the miners, all the buyers, all the traders all coming together, and a lot of information circulates that doesn't usually circulate. So not surprising that you suddenly see that bullish activity right after that, as everyone leaves with new intel about what's happening in the market.
Yeah.
And oil, obviously, big subject in the news at the moment. Obviously, one of the most popular commodities with retail investors as well. Up until the recent events, seemed to be very efficiently priced. The market had a very clear idea of where the oil price should be, and looked quite range bound. And then, obviously, the war between Israel and Iran has pushed that up a grade, and now it's changing every day, so it's really difficult to talk about this, because what we're talking about now could be out of date by Monday. So but I mean, what's your take on the oil market right now? Because some people are now saying, oh, it's if this keeps going, the sky's the limit on oil. We're talking $110 oil again, and then that's going to impact just about everything else, including global economic growth.
Yeah, well, I certainly do think that the geopolitical news is a source for uncertainty, and I think oil prices will keep spiking each time there is an indication of escalation, especially in the Middle East. However, I am a little bit cautious on that front, because what's going on there is a war between Israel and Iran. If Israel obliterates all of Iran's oil producing capacity, takes it offline, we think that there is enough spare capacity within the OPEC group to make up for that. And quite frankly, the OPEC group, the rest of the OPEC group outside of Iran, have been itching to use some of that extra supply. Over the last few months, OPEC has been increasing its supply, unwinding its kind of third layer of restraints, its so-called voluntary restraints by the OPEC Plus subgroup of 8. Mm-hmm. They have been increasing their the volumes that they're going to put into the market by way more than what they advertised back in December, when they said they would be unwinding that layer of restraint. And it's clear that the United Arab Emirates and Saudi Arabia have plenty of spare capacity at this point, and could utilize that. So that could dampen some of the impact of Iran being taken out of the market. Now, other fears are that Iran will sabotage the movement of oil around the rest of the world. Iran sits right next to the Strait of Hormuz. It's the world's most important choke point in terms of oil transit. Mm-hmm. I'm just not sure that is really an option for Iran. It will meet the ire of all of its neighbors if it does that, and it as a political entity, it just won't be able to exist if it takes that step. So I do think that is the kind of, excuse the pun, the nuclear option, right? It is really a last resort sort of thing, but it has no benefits to Iran to take that option. So I'm somewhat optimistic that there is enough oil availability around the world, and certainly before the geopolitical situation really kicked off in earnest last weekend. Um, it was looking like that uh, conditions for the oil markets would get weaker as we progress into the year. Right now, we have strong seasonal demand for oil, and that has kept the spot markets or the prompt markets quite tight. But with all those barrels of oil coming from OPEC, weakening demand, China transitioning us very quickly away from hydrocarbons for transportation. Um, we do think that that there's going to be some demand weakness later on this year, and that's kind of describes why the um, oil futures curves had that kind of funny look about them, right?
Hmm.
They were only backwardated at the very front end, and then went into sort of contango there afterwards. So it had a kind of a smile shape, and now the futures curve, when they're in backwardation, it does indicate tightness in the market. That tightness in the market seemed to be in the short term. That contango, which indicates a bit more looseness in the market, is there, after sort of 6 months. So we thought there was good information in that futures curve, indicating the fundamentals of the situation in oil markets. Obviously, we now are living with a large geopolitical premium, which will be there for as long as there are these tensions. But if it gets resolved, that could come off.
And you also have a US administration that's very pro oil and has shown its capacity to just turn the taps on there as well, should the price get high enough. So
Yeah, with the US, it's a little bit more complicated because unlike some of the OPEC nations, it doesn't have a national oil company. It can't order anyone to increase supply.
true, true.
It just has to provide those incentives.
Yeah.
So Trump's dreams of drill, baby, drill, probably somewhat tamed now because the oil prices up until this geopolitical issues flared up weren't sustainable to increase production, and that's why Trump had been so keen to get OPEC to increase its oil supply. So those oil supply increases that I mentioned earlier on, they were in tandem, or they happened shortly before Trump's visit to a number of key OPEC countries, last month. So that did seem to be a nice sort of quid pro quo. Kind of there's a nice deal to there's nice deals to be done after increasing oil supply from some of these key OPEC nations.
And I was at a Bloomberg conference a couple of days ago, and they were all talking about livestock futures. They were very excited. What's happening in that market? Because that's not one that tends to get as much publicity as some of the other key commodity markets.
No, you're right. It tends to be a little bit forgotten, but if you look at the volatility in livestock, there's plenty of excitement for those who do trade them. So yeah, it's clear that when it comes to both cattle and lean hogs, there's generally not enough supply, and demand is remaining strong. Um, Drought in some of the the pasture fed areas for the livestock has impacted the yields, and on top of that, we are entering into the seasonal sort of culling periods where there's less availability of the cattle and the hogs. So that is contributing to tightness in the market. So it's clear that there's a supply demand imbalance, and there's been a nice price rally on the back of that, which is bringing excitement into a somewhat forgotten area of the commodity spectrum.
And Just finally, obviously, we've been talking a lot about geopolitics on this podcast today, and the fact that there's things for people to worry about as investors, and this is the same for small investors as it is for large ones. Often they say exactly the same things, whether you're a pension fund or whether you're just someone running your individual ISA account. And they're obviously worried about the news flow, and it doesn't seem to stop. I mean, year in, year out. I was talking to a fund manager recently who said, I'm getting very bored of people telling me I'm seeing a once in a generational crisis because one seems to come along every year.
Yeah.
But that doesn't get away from the fact that you still need to manage your money and invest, and if you put everything in cash, you're going to get punished in the end. We've already talked about central banks printing money, for example. Do you think commodities has more of a role to play for investors, not just institutions, but also smaller investors as well? I know that it sort of changes from country to country. So, for example, in South Asia, people are much more switched on with gold. But if you just take, for example, the UK, people have been less familiar with commodities markets and less active in them. Do you think that this ongoing geopolitical risk situation will get people looking more at commodities as an alternative to equities or even a complementary asset class?
Yeah, I certainly think that there is a lot more room for diversification in anyone's portfolios. Markowitz was famous for saying diversification is the only free lunch you get in the investing world, and that is true. The more variety of things you have in a portfolio, the more robust that portfolio is, the better it withstands stresses and produces better returns, risk-adjusted returns. And obviously, the realization of a lot of the risks that people were thinking about is here right now, right? We have a trade war ongoing. We have a physical war, or several physical wars around the world ongoing. They are all likely to have an inflationary impact on some goods, and probably some goods and services. So if you look across various asset classes, what's been the best tool for hedging inflation? Hands down, it's been commodities. Commodities have the strongest inflation beta, but not just inflation beta on its own. If you look at surprise inflation, so the kind of inflations that have been very difficult to hedge with, say, treasury inflation protected securities, or very hard to hedge with cyclical assets like equities. Commodities, while being cyclical, have done a fantastic job at hedging against those price risks. Typically, we see like what's happening right now. Oil price spikes due to concerns in a certain area with wars drive oil prices up. That gets fed directly into a commodity basket. Whereas if you're trying to hedge it with other instruments like tips, for example, it has almost no impact on the tips yield, and therefore you don't get that inflation hedging protection from that. So I do think that more and more investors will be looking at commodities, especially in a world of transition as well. We're seeing an increasing number, not necessarily retail investors, but institutional investors think about what is the world likely to look like in 10, 15, 20 years' time. And that is likely to be a world where we are less dependent on hydrocarbon sources of energy and more onto renewables, and those investors are seeking exposure to the kinds of materials that will prosper in that environment, and that's primarily metals. So we are seeing kind of that thematic slant to commodity investing take place as well.
Very true. Well, thank you very much indeed for coming on the podcast today and talking about quite a few commodities markets. I mean, there's lots more we could talk about, but we'd be here all day. But I think it's a fascinating subject. I think for investors to be able to dive into that and educate themselves a bit more, I think they would find it very valuable.
Thank you very much. It's been a pleasure.
Thanks for watching the Investing Markets and Money podcast from the Armchair Trader. Please leave a comment and please subscribe for further updates on our channel.